As humans, we really pride ourselves on being builders, right? We're innovators, we're smart. We invented electricity, vaccines, the internet, and somehow we also managed to invent the cronut. But there is one glaring thing we have been doing over and over again for the last 200 years without fail with an almost impressive level of consistency. And I'm talking about our habit of repeating the exact same financial manias. Welcome to This Explainer. Today we're taking a hard, honest look at the history of financial bubbles, and more importantly, how that history is speaking directly to us right now when it comes to artificial intelligence. So the big question we really have to ask ourselves here is, why do we keep doing this roughly every 2 decades? The historical cycle is incredibly reliable. It goes like this. We find a revolutionary new technology, we get incredibly excited, and then we pour insane, eye-watering amounts of money into it. The price goes completely vertical, everyone gets rich on paper, and then boom, we watch the whole thing fall apart. Only to, dust ourselves off and do it all over again 20 years later. Okay, let's dive right into this. Here is our roadmap. Number 1, the Railway Mania. Number 2, the Nifty 50. Number 3, the dot-com bubble. Number 4, a pattern emerges. And finally, number 5, the AI question.
Chapter 1. The Railway Mania, 1850s Britain.
Picture this. The Industrial Revolution is absolutely booming, and steam railways are genuinely and radically transforming the economy from horse and cart speeds to something totally new. And investors? Well, they lost their minds. They poured money into railway companies at a staggering, unprecedented pace. Between 1844 and 1846, the British Parliament approved a massive 9,000 miles of new railway lines. Companies were literally being formed weekly. And it wasn't just the Wall Street types of the era, everyone was buying in. Aristocrats, merchants, farmers, even clergymen. It became a complete national obsession. All this frenzy drove railway stocks up over 300% in just a few short years. And the logic driving this was simple, aggressive, and honestly, incredibly seductive. The thought was, trains are the undeniable future. Everyone is going to use them. Therefore, the companies that own the rails will be worth an absolute fortune. Makes sense, right? But the problem was that way too many lines were being built. Many routes had zero realistic chance of ever actually turning a profit. Companies were vastly overcapitalized, underfunded, and in some cases, they were just outright fraudulent, literally selling shares in train lines that existed only on paper.
So, the crucial point is what happened next. By 1850, the bubble totally collapsed. Shares fell 60 to 70%. Thousands of everyday investors were completely wiped out. Banks failed, and construction just halted. But here is the massive twist. The railways themselves actually survived. By 1900, Britain had one of the most comprehensive rail networks in the world. The investors who bought during the mania lost everything, sure, but the underlying technology actually succeeded. The railway was real. The valuations were just insane.
Chapter 2. The Nifty 50, 1960s and 70s America. Fast forward to post-war America. In the 60s and 70s, Wall Street became completely obsessed with a group of dominant stocks known as the Nifty 50. We're talking about the absolute titans of American industry here. IBM, Xerox, Polaroid, Coca-Cola, McDonald's. The logic of the era was incredibly elegant, but extremely dangerous. Fund managers confidently called these one-decision stocks. The belief was that these blue-chip companies were so fundamentally dominant, so perfectly managed, that you could buy them at literally any price and never, ever sell them. Because hey, they're the best companies in America, right? They'll always go up. This perfectly illustrates how disconnected from reality things got. A normal price to earnings, or PE ratio, and a healthy market is somewhere around 15 to 20. But the Nifty 50? They were trading at absurd valuations. Polaroid, which was a great company producing real products, was trading at 94 times earnings. McDonald's was trading at 83 times earnings. They were priced as if literally nothing could ever go wrong. And then, the 1973 recession hit, triggered by the OPEC oil embargo. The market crashed, and these supposedly bulletproof stocks got absolutely destroyed. Polaroid fell 90%, Xerox fell 71%. Even the fundamentally sound companies with real earnings got cut in half. Why? Because the prices had completely detached from reality. You can own the absolute best company in the world, a true heavyweight, and still lose your shirt if you grossly overpay for it. Quality is real, for sure, but an infinite price-to-earnings ratio is not.
Chapter 3. The dot-com bubble, 1995 to 2002. Welcome to the 1990s, where the internet was the big, new, revolutionary technology. And just like the steam engine, it was genuinely revolutionary. Email, e-commerce, global communication, it was all real and it all actually came true. But the financial frenzy it spawned was something for the history books. And this brilliantly illustrates what I mean. Between 1995 and March 2000, the tech-heavy NASDAQ index exploded from around 750 points to over 5,000 points. That is a 566% increase in just 5 years. It was fueled by companies going public at billion-dollar valuations with literally no revenue, no business model, and sometimes no actual product. We literally had companies raising millions just to spend it all on a single Super Bowl ad before going bankrupt just a few months later.
The reigning philosophy at the time was called the new economy. Serious people in suits were out there arguing that traditional metrics like profits just didn't matter anymore. All that mattered was eyeballs on your website. Well, reality eventually called in the debts. By October 2002, the NASDAQ crashed 78%. A staggering $5 trillion in market value just evaporated. Thousands of companies were wiped completely off the map.
But again, look at the survivors. Amazon survived, Apple, which was nearly dead in 1997, came roaring back. Google launched in the middle of all this and became an absolute titan. The internet didn't die. It was completely real. It just took a little longer to mature, and it certainly didn't need 50,000 wildly overvalued companies to succeed. The technology was right, but the timeline and the valuations were dead wrong.
Chapter 4. A pattern emerges. The 6-step cycle.
All right, let's hit pause on our historical tour for a second. Because if you've been paying attention, you've probably realized that every single one of these massive historical events followed exactly the same script. I want to walk you through this undeniable 6-step pattern. And as I do, I really want you to think about today's market. Step 1, a transformational new technology appears and it's genuinely real. Step 2, investors excitedly extrapolate that transformation into infinite future profits. Step 3, valuations completely detach from reality as people invent new metrics to justify insane prices. Step 4, something breaks the spell, maybe a rate hike, a missed earnings report, and the narrative cracks. Step 5, a generational crash wipes out the speculators. And step 6, the underlying technology actually survives and changes the world, but the investors who overpaid still lose everything.
Whether it's steam trains, blue chip stocks, or the internet, it is always the exact same story, just dressed up in a different costume. And every single time, people look around and confidently say, "This time it's different." Let me tell you, those are, without a doubt, the 4 most expensive words in the entire history of investing.
Chapter 5. The AI question.
Now, look around.
I promised you an impartial look at where we are today with artificial intelligence so you can draw your own conclusions. We are going to look strictly at the facts here and leave the emotion completely at the door. Here is the absolute neutral reality. Let's look at the bull case first. AI is not just hype. The tech actually works. It's cutting costs, it's writing code, it's discovering drugs. NVIDIA's revenue grew over 120% in a single year. That is hard data. And McKinsey estimates AI could add a mind-blowing $13 trillion to global GDP. Now, conversely, looking at the bear case, since 2022, tech companies have spent over $300 billion on AI infrastructure. Where does all that money come back from? There's a massive monetization gap right now, and companies like NVIDIA are trading at over 30 times sales, which means they are priced for absolute perfection. This right here is the core dilemma facing the market today. AI is undoubtedly real. But remember our tour? So were the railways. So were the dominant businesses of the Nifty 50. So was the internet. History tells us with remarkable consistency that the technology almost always wins in the long run. But the investors who buy at the absolute peak of the mania almost always lose because they pay a price that assumes instant, frictionless perfection. So I want to leave you with this final provocative thought. The question you need to ask yourself before putting your hard-earned money into the AI boom is not, is this technology real? We know it's real. The real question is, at this price, how much good news is already baked in? Asking that question and having the discipline to answer it honestly, well, that's exactly what separates the real investors from the speculators. Thanks for joining me on this explainer. I'll see you in the next one.